Howdy there, folks. Welcome into today's video. It's a buy one, get one free here today in this one, folks. Two videos for me to react to in this one. First one up here, the Professor Jeremy Siegel from Wharton is going to explain to us why the equity markets, meaning the stock market, are about to go to new highs. That should be interesting. So looking forward to getting into that one. And then since we're going to watch a bullish video, I figure we'll balance out, as all things should be in life. Let's watch a bearish video, okay? We expect a downturn in Q1 2024 as student loan repayments kick in, which is obviously a big subject, right? The student loan payments start again, if I recall, around September, October. We'll see how all that shakes out. I mean, from what I hear, people are still trying to block that whole deal, but nonetheless, folks, that's what's going on. So appreciate everybody joining me for this one. Thank you for being here, folks. We are now at a new all-time high subscriber account in the history of the channel. I believe 31,500 plus subscribers now. I appreciate each and every one of you, 31,500 plus subscribers on the channel. Thanks so much for being here, folks. Also, just so you know, I recorded you guys a free workshop a few nights ago. If you want to access that, check out the pinned comment down there for free access to that. It's about a 30-minute long video, how I find 10x stocks. Definitely make sure you get access to that at the end of this video here. Alrighty, let's get into it.
Wharton School. He is live with us once again. Professor, it's nice to see you again.
Good afternoon, Scott.
We heading towards new highs, Professor?
I think so. I mean, this is such a strong market. You hear the guidance from the firms that was so tentative. In the first and second quarter, a lot of it is so much more confidence. The internals are improving. It's broadening out. The ECI, that employment cost measure that Chairman Powell mentioned a couple days ago, came in below expectations, as well as the others. Goldilocks, lower inflation and stronger economy and good guidance and good profits. What's to stop this market now?
I don't know. Jay Powell and company, maybe. You think they're done?
I'm not sure that they're done, but what I'm pleased about is that he acknowledges that there are two-sided risks, that he's going to, every meeting is a live meeting. There's no preconceived motion about whether they're going to go up or down. They're going to look at the data, which is something that, I've urged for quite a while. Frankly, as you know, when I saw the money supply go down, decelerate by the greatest amount in history, I was concerned. I was worried about what was going to become of the economy in the second half. And I'll tell you, the first half, I don't know anyone who thought that the first half would grow faster than 2%. I would look back in my records, even the Fed was way below that in its estimate. So inflation coming down, stronger economy, I don't see this stopping anytime soon.
Do you think that the Fed is looking at the right thing? I mean, there are some who suggest that they're fixated on lagging.
So let me explain the major risk, okay? Because there's a few risks out there, but there's one major monumental risk, okay? And this is a risk that can catch up to the stock market at some point, in the overall economy at some point. The big question is, when does it do it? Like 3 months, 6 months, a year, 2 years? The huge monumental risk out there is interest rates, right? The longer the Fed keeps rates at a much elevated pace, especially, compared to what we've been used to for the past 20 years, the more risk it eventually has of bringing the economy down. We have not seen it yet, okay? We've seen interest rates definitely affect some areas of the economy, but we haven't seen it to a big extent. When you see it to a big extent, that's when you start seeing job losses and it starts saying, wow, okay, things are starting to get ugly, okay? We haven't seen that yet. So at some point in time, all these interest rate hikes the Fed has done, it is going to be a risk to the economy. We just don't know when, and that's the big problem there. And usually after the Fed goes through a big hike cycle, many times they'll have kind of a cool-off period. You kind of get this Goldilocks environment, and then things start to break and start to go downhill. And then the question is, how far downhill do you go? Are we talking like great financial crisis, like, that's like end of the world type stuff? Or are we talking more like, economy pulls down, you have a very small recession, maybe unemployment goes to 5%, and then you start coming up and get better from there, okay? So that's the big kind of question mark, and I think that's still a boogeyman that's out there that we all have to pay attention to.
Indicators, and not enough on what's actually taking place on the inflation front. The danger, of course, being that they end up going too far as a result. Do you share those concerns?
Well, I did a lot earlier on. I still have trouble with this year over year because it's 11 months of old data and then 1 month of the new data. And we all know how lagged the housing indicator, which was, still recording increases every month, even though it's gone down.
It's interesting. A lot of these dividend stocks are just still being such laggers. WBA, they just showed there. In a lot of the big yield dividend stocks, a lot of people want no piece of those. Why don't they want a piece of those? Well, you can get 4 or 5%, whatever, basically guaranteed in savings account, treasuries, things like that. And so people are like, why do I want to risk my money to get 5% in dividend stock or 6% when I can get risk-free 5, 6%, 4%, whatever, right? So at some point in time when rates aren't up where they are right now, right? And at some point in time, things do break and they bring, bottom line is, if you want to know when dividend stocks start to perform amazing, I'll tell you exactly when. The moment the Fed, things break in the economy and the Fed has to also cut rates substantially again, which once again, we don't know when that is. It's going to happen someday, but whenever that happens, that's when the move back to dividend stocks really comes in, okay? You can still get some performance here and there, but you're not going to see it in a substantial way until all of a sudden you have trouble getting yield. People are into dividend stocks mainly. I use dividend stocks as a way of diversifying my portfolios and a way of building wealth. A lot of other people think about dividend stocks in terms of, I need somewhere to put some money so I can get some yield. And when savings accounts are giving you 1% or no percent, right? People say, where am I going to put money? Oh, treasuries, I could get 2, 3%. That's nowhere to make money, so I'll go ahead and put it in dividend stocks. But right now, savings accounts are yielding really high if you are with the right financial institutions, obviously. And obviously, treasuries are a hot place to put money right now.
Year over year. But I think now the Fed gets that. And they
Plus, you got a lot of bonds that are yielding, pretty high numbers right now.
Is that there are a lot of lags in that system, and that they have to look at that forward-looking indicator. So I'm less worried about that now than I was 3 or even 6 months ago.
The bears would say, and we're going to talk to one in a minute, by the way, and we're going to have a debate.
Okay.
But they would say that, the bulls will come up with any excuse to justify valuations which are stretched. They're stretched far past historical averages. And given the environment we're in, where earnings are still not great, better than feared isn't good enough to justify valuations here. How would you respond to that?
Well, the S&P is selling about 20 times next 12 months. My research shows that that's about average. I mean, the tech stocks are 30, the value stocks, the cyclical stocks, so fearful of that inflation are 14, 15, 16. That's extremely reasonable. So, you could argue that the tech stocks may be a little bit over their skis in terms of how far they've gone. I would prefer the value stocks on the long run. But when I look at this market as a whole, I do not see any significant overvaluation. I think back in the dot-com bubble where the S&P was selling over 30 times earnings in a much higher interest rate environment than we have today. That was scary. I don't regard today's valuations as scary.
So a lot of people think if we do have some sort of recessionary scenario, we're going to see the indexes go down 50% plus, like what happened in the Great Financial Crisis, right? In the Great Financial Crisis, peak to trough, each one of the 4 major stock market indexes, the Russell, the Dow, the S&P 500, and the NASDAQ, all went down over 50% peak to trough in the Great Financial Crisis, which is an extreme hit. When you get, last year was nasty, but last year we saw S&P down like 22%, 23%, maybe 24% peak to trough. We saw NASDAQ like 38% peak to trough, 37%, somewhere in there, right? But a lot of people are thinking, can a 50% type drop happen? My answer to that is, it is possible, but the more I look at it, it's going to be tough sledding to get any sort of drop, even if you have a major recession. Here's why. When you went into the Great Financial Crisis, you didn't have a ton of people making massive amounts of money in treasuries and savings accounts. The big difference is right now, there's trillions of dollars in savings account and treasuries right now, just collecting all that interest, getting paid out all that money, right? That's chilling there. Well, imagine a scenario where a recession starts to hit, the market starts going down, and all of a sudden treasuries start yielding yet less, savings start yielding less. all of a sudden people start saying, well, all these stocks are a great deal, and my savings accounts now is getting me crap because the Fed's dropping rates, and so that's affecting everything across the board. Treasuries aren't yielding what they used to yield, so you know what? Let me go buy the dip. And that's where it gets really hard to see one of those like epic drops, even if you had a major recession. And so I think that's something that's important that people just understand, because a lot of people just assume like, this thing happened last time, so therefore this is going to happen again. And that's exactly what caught people in a lot of trouble this year, right? Everybody started thinking like, this is going to be some major recessionary first half of the year, and it was going to be down and out and blah, blah, blah. It has been the complete opposite. The economy's held up very well. Earnings have held up very well. And if anything, look like they're going to strengthen in the back half of this year, which just blows everybody out of the water, because really no one had really forecast that out there, right? Alrighty, let's get into this one.
Mark Giannone. Mark, good to have you here.
Thank you.
I kind of laid it out for why do you expect, I guess in many ways you're in the higher for longer camp. Would that be fair to say?
That's fair to say, yeah. Good morning. Thank you.
Is that Melissa Lee? Holy smokes, man. She'll just dip and like go on vacation. She must get a lot of vacation time from CNBC, but then I think she's got something going on where maybe she like has to work some extra shifts and then like gets extra vacation or something like that. Because a lot of times I'll just see her missing from Fast Money for a long time, and I'm like, what happened to Melissa Lee? She must be on some epic vacation. But the next thing you know, she's doing like 6 different programs on CNBC. I'm like, maybe she's got that like nursing schedule going on or something like that.
Much for having me. Yeah, absolutely. I think we got great news on the inflation front, no doubt about that. We learned that with the CPI like a couple of weeks ago. We saw a confirmation of that in the PCE number this morning. I think the Fed expected that number to be pretty weak as well on the PCE number. But we cannot take that as a signal of the future trend of inflation. And in particular, I think the Fed is going to be pretty concerned about the chance of inflation remaining as low when it sees that the labor market remains so hot, when it sees that consumption remains really, really strong, and it continuing to power the economy. So I think demand is still really strong. We've seen some slowing over time. We've seen some gradual moderation in the labor market, but I think the labor market imbalances are still there. And Chair Powell has highlighted those upgrade in the outlook projections.
Okay, so let me tell you what I'm seeing in Vegas right now, and this makes things very, very tough. Okay, if you don't know, I live in Vegas. Okay, my whole city's under construction. My whole city's a freaking construction zone right now. You can't go anywhere in this damn city without running into construction. I'm telling you, every freaking highway, road is under construction. Like, they can't get enough construction workers. You got apartments being built all over the place. You got them trying to get ready for the F1 race here in Vegas. So there's pretty much have tore up the whole strip. The whole city's a construction zone. It's out of control. And all I think about every time I drive is, why the hell am I driving out here? Because this is like such a waste of time, because it freaking takes so long to get everywhere because there's so much damn construction everywhere. The other thing I think about is, man, that's a lot of jobs. And there's actually a shortage of construction workers right now, right? We have, oh gosh, I don't even want to get into it. We have immigration situations where it's very hard to even get in the United States of America at this point in time. And we're such in a state in the United States that we're trying to only take high-level professionals and trying to be so picky with who we take. But the problem is, many of those people aren't working construction jobs, okay? If you want to take in the guy that's got $1 million and has this high skill that's going to go work for Microsoft, okay, but he's not going to build you the damn freeway, okay? So we got a problem in this country where we're not really bringing in the type of people that really are the ones who build the country. Because at the end of the day, the ones that have always built this country have always been usually the first generation people to the country, or maybe second generation people to the country. That's how this whole damn country is built. Every time you go to use your internet, every time you go to make a phone call, every time you go to use a freeway or an interstate or any road for that matter, just remember, usually those were all built by people that were first and second generation folks in the United States of America. And the problem is, we're not taking in those folks. We're trying to be so selective, and so it creates this dynamic where we got this shortage, or you're having to pay so much for construction work because at the end of the day, it's hard to come by. And so they have to keep up in wages. If you keep up in wages, obviously that could lead to more inflationary problems, right? So this is where you're into some of these different pickles out there. But nonetheless, I mean, with the infrastructure package, obviously the government passed, right? I mean, that's like years and years of construction work ahead. So we need a lot of infrastructure being built in obviously this country. But, at the end of the day, man, there's definitely a shortage of workers in the construction field, no doubt about that.
I think we'll start seeing the impacts on the consumer. I think, the piece of the puzzle that so many have...
The one thing I've been thinking about, and something I've been considering, is if there was a recession, the one good thing is, obviously, people lose jobs, and I can tell you there's a lot of jobs to be had in construction. And usually if people lose jobs, they think, okay, where can I make good money? And what's a safe job? And I can tell you, construction work, usually, especially if you're on anything that's like state related, city related, things like that, usually very stable jobs, and they usually pay pretty darn good money. Like a lot of those jobs pay $70K, $80K, $60K, $90K. And I'm talking about for a city like Vegas, that's pretty decent money. So yeah.
Notion of the lock-in effect that much of consumer debt, much of household debt is actually tied to rates that don't move. They are fixed. I think 11% of household debt is tied to variable rates. So at what point do you expect to see that hit the consumer, and therefore we'll see that slowdown in consumer spending that we do need to see?
That's right. No, so we saw a very strong first quarter where consumption grew like over 4% quarter on quarter annualized. It slowed down in the second quarter. We expect that to continue to slow down in the third quarter, and then in the fourth quarter actually to flatten out. Part of that, I think, is going to be the resumption of the payment on student loans and both the amortization and the interest payment on student loans that are going to start kicking in the fourth quarter, and probably subtract like a 0.8% to growth in that quarter. So that could actually slow down consumption there, and we expect that to continue overall in the first quarter of next year as well. So we expect a slight downturn taking place in the first.
Are you surprised at the strength of the consumer thus far?
Oh yes, of course. We've been surprised consistently with the strength of the labor market, the strength of the consumer. I think there's a very strong feedback loop that's going on between the tight labor market that keeps generating jobs, bringing in people into employment, generating income, and with that income fueling consumption. And that consumption then, as households turn towards services, which is pretty labor intensive, maintains the labor market really tight.
What about the spending by the government itself? We've got the CHIPS Act, we've got the Inflation Reduction Act, we've got the infrastructure bill. Yep. A lot of money going into various projects around the country. Does that have an impact?
Oh, it does, certainly. So it's not only a lot of money from the government, but also provides incentive to the private sector, right? And we saw a lot of investment in equipment, infrastructure in particular, in the second quarter as well. And construction spending for infrastructure projects is really, really booming at this point.
But basically you're saying, I'm sorry to go back to this, but it really was interesting the way you're talking about student loan. That's going to slow down the consumer. That's the biggest impact. So there's really no, in your view, transmission mechanism from the Fed raising rates to the consumer immediately. It sounds like it's all going to come from the problem that consumers will have in terms of paying back their student loans.
So I do think that the interest rate effect will have will have an impact on consumption over time. So as rates go up, the incentive to save are also a little higher, and as people also deplete the accumulated savings that they got during the post-pandemic period, they are going to feel a little less wealthy over time, and are going to slow down their pace of consumption. So I think this is all part of the traditional transmission mechanism of monetary policy, where over time, as rates remain elevated, it starts biting the consumer more and more over time.
But the crazy part is, for every kind of negative, we can say, like student loans, for instance, I can make a positive. For instance, real wages are finally going up again, past couple quarters, and should get even better. Real wages kind of meaning like, what people are getting for raises at average or their workplace, or how much more money they're making versus like what your, CPI is at, for instance, right? That was in a bad place for over 2 years, and we finally are getting that to a positive state. So, man, if for every one of these negatives, I can counter you with a positive or two positive, and that's what's making a market right now, because it's a very, very intriguing time. So appreciate everybody being here. As always, thanks so much, folks. Thanks for being subscribed. Make sure you check out pinned comment down there. Get access to that free workshop I put together for you guys. It's I think it's a 29-minute video on how I find 10x stocks. That should definitely help you out if you're looking to kind of build your portfolio up and whatnot. Thanks so much for watching. Have a great day.